and CNBC founder and Target Media chairman, Tom Rogers. Tom, it is always a pleasure to have you here on set.
Great to be here.
So subscriber growth, profit growth in the streaming business, it shows that integrating Hulu, integrating sports content into Disney Plus, that is working. Are you more of a fan these days?
Well, you got to give them hats off on the numbers.
Yeah.
And you got to say that the parks really did perform against an environment where travel seems to be slowing down, particularly international travel. And Abu Dhabi and new cruise ships is a big deal. And as I said here before, huge deal that Disney is the first legacy player for its streaming revenues to exceed its linear revenues. Okay? I like it.
I feel like there's a big but.
I don't love it, and there is a big but.
Okay.
Because saying their streaming subs were strong at 1.4 million, where they got a whole lot more headroom for growth than Netflix does, and Netflix grew 41 million over the last 12 months, that is not strong performance. In fact, for the first 6 months of the year, Disney Plus is down. Well, I shouldn't say that. They were down last quarter. They're under 1 million subs for the first 6 months. Now, Disney needs a catalyst on the streaming side. Mm-hmm. Why? Because it's not just sluggish growth. Their DTC advertising, their streaming advertising, was sequentially down 13%. We have a massive reallocation of advertising revenue going from linear television to connected TV. Hulu is the granddaddy of advertising-supported streaming, and they're down 13% sequentially. You have the further issue that those sub gains, which were obviously modest, came off the back of a $2.99 promo for Hulu and Disney Plus for 4 months against a typical price of $10.99. And a lot of those subs are subs that are packaged into the Charter or other cable bundles where people get it, but they don't watch it. And they do have an engagement issue on their original television production. Believe it or not, the #1 performing show on Disney Plus is Bluey. 9% of all viewing.
Yeah.
But it's an acquired program. Now, their Disney films do really well, but the Disney originals don't. So they do need a catalyst. I think this ESPN flagship announcement next week, which will talk about price and a new name, but more importantly has to talk about the bundle with Disney Plus and Hulu and the bundle pricing, because there is an opportunity to create an all-family sports, kids show, adult programming in one package. If it's truly integrated with a great interface and great recommendations, they could really catalyze their streaming business, which I don't get real excited about based on these results.
So, Godfather, I think you just said it, and I would just get back to the operating income of this quarter. That was better than expected, which means that ultimately the profitability of the business that had been lacking for so long, in a backdrop where, we know linear TV is dead. We know we know that the bundle has been broken, but it's been repackaged. I think it feels like you just said it. We're now could be looking at this company a little bit differently now that they can be profitable in their core business. In fact, I would argue that the biggest impediment to Disney's share price right now is fear on the economy and just how exposed parks would be. And then the advertisers. I mean, at the end of the day, it is a cyclical business.
Well, remember where we're coming from, though. We're coming from Disney being the kings of the cable business, where cable programming services had margins of 45 to 55%. And the streaming business, it is profitable, but the margins are nowhere near that. Now, the CFO said, well, there's some cost opportunity to expand margins along with their revenue growth. I question that a bit. They're going to have a massive allocation of costs based on these big sports rights, which are now going to increasingly show up as costs on the streaming side of the equation. Plus, they're going to need to spend a lot of money on local programming for international distribution, which is where they're really lagging on the streaming side relative to Netflix. So I think they got a long way to go on the margins to really be in a position that we're recreating anything close to the former business. I shouldn't say former, current linear business.
Tom, it is always great to see you. Thank you. Tom Rogers, a.k.a. Godfather.
The Godfather.
Of course, you'd be the founder of CNBC.
Wait, by the way,
royalty.
Guy is texting me right now.
STUD.
He said, STUD. He said to call Tom a stud. Just want to be really clear.
I've never heard that before.
No,
That's remarkable.
He's the